Hi, this is Alan Tribble. This is my next drop in the series of video clips on the topic Business Management for Scientists and Engineers. I'm going to have two separate drops on financial accounting, and this first one will address orders, sales, and earnings, otherwise known as profit and loss. Let's begin by defining a few terms. An order is a formal request for an item. Orders, plural, is the total of each individual order. Sale is receipt of money for the item. Sales, plural, is the total of each individual sale. That distinction is important because in some businesses there can be a significant time difference between when you receive the order and you receive the income from the sale. In the case of a restaurant, the order is placed when you tell the staff what you would like to eat. The sale is made when you pay for your meal. In the case of a fast food restaurant, there may be only a moment or two between when the order is placed and the sale is made. They'll take your money first and give you your food a few moments later. In the case of a fancier restaurant, they may take your order, bring you some appetizers, let you eat, see if you'd like some dessert or after dinner drinks, and then give you the bill for your payment. There could be an hour or two between when the order is placed and the sale is made. In the case of other higher technology products, there could be a difference of weeks, months, in some cases years, between when the order is placed and the sale is made. That's why it's important to track orders and sales separately. Expenses are all of the costs you have to pay for in order to provide a good or service. In the case of our restaurant, it would include the cost of the food, wages for the staff, even rent on the building and utilities. The most basic accounting relationship is profit is equal to sales minus expenses. If your profit is positive, you're making money. If the profit is negative, otherwise known as a loss, you're losing money. As the prior equation shows us, the only way to increase your profit is to either increase your sales or decrease your expenses. Most businesses try to do both proactively, but just like we do with our personal finances, it's always an ongoing struggle to balance our income with our outgo. To see the big picture, we'll be referring to the figure seen here. At the top left, we have customers, our address market, and at the top right, we have owners. Let's step through each of these boxes to understand how money flows from our customers to our business and eventually to the company owners. We're going to quickly define each of the 9 boxes or terms shown here to understand how gross sales translate into net profit. Gross sales is the total of all the individual sales. It could simply be the number of items sold multiplied by the manufacturer's suggested retail price, also known as the list price. Gross sales are usually more important for the consumer retail industry, like our restaurant, versus higher tech industries. Still, gross sales is a rough measure of the amount of product sold and cash generated. First, we reduce gross sales by factors we call adjustments. Adjustments are things like returns, when a customer returns a defective or damaged product and asks for a refund. If a customer in our restaurant orders a hamburger with no cheese because they're allergic to dairy products, but the server brings them a cheeseburger instead, they will return it and ask for a plain hamburger. Our restaurant has to eat the cost, pun intended there, of the cheeseburger. Allowances, when customers agree to keep damaged merchandise for a reduction in the selling price. If a customer wants an appliance, but the only one in stock is scratched or dented, they could agree to take the damaged one now in exchange for a lower price. Finally, discounts, a reduced price offered for paying in cash or within a certain amount of time, or for buying in volume. When we subtract the adjustments from gross sales, we're left with net sales. Net sales are a better measure of the actual cash generated by the business. On the income statement, sales typically refers to net sales, not gross sales. Net sales are also referred to as revenue. Next, we reduce net sales by the cost of goods sold, often abbreviated COGS. As the name implies, this includes all the costs associated with directly producing the goods that are sold. In Adam Smith's terminology, this would be two of the three factors of production: land or raw materials and labor. Capital expenses will be treated separately, as we'll see in a minute. Note also that the cost of goods built but not yet sold are what we would call inventory. This may be important for some businesses, and those costs are treated separately because they haven't been sold yet. They're still in inventory. Subtracting the cost of goods sold from net sales gives gross profit. Gross profit is also known as sales profit. It's a rough measure of how profitable a business is, but is not yet accounted for all other expenses associated with doing business, such as operating expenses. Next, we reduce gross profit by other expenses incurred in carrying out a business's day-to-day activities that are directly associated with staying in operation. Operating expenses can include a lot of things, but two big categories you often see used are general and administrative, or G&A, and selling. This can include things like rent, utilities, employee benefits, management salaries, travel, and so forth. These are costs that we have to spend to stay in operation, but are somewhat independent of the individual products we are delivering to our customers. Subtracting operating expenses from gross profit gives operating profit. The final category are the non-operating expenses. As the name implies, non-operating expenses are costs that are not directly tied to staying in operation and often includes the cost of commitments or decisions made in years past. It includes things like interest on money you've borrowed, as well as any taxes you have to pay. It also includes capital expenses, one-time expenses to acquire or upgrade physical assets with multi-year lifetimes. This may include facilities, test equipment, and so on. These expenses are amortized or depreciated over many years, so most accounting principles and tax laws require them to be treated separately. Depreciation of assets is a cost accounting method used to allocate the cost of an asset over its entire useful life rather than simply the year in which you buy it. For example, if you purchase a piece of test equipment and you expect it to stay in service for 5 years before you replace it with newer technology, you would then depreciate its cost over each of the 5 years it's in service rather than simply the year in which it was purchased. This gives you a chance to allocate the cost of the asset with the revenue it helps to generate year over year. Finally, subtracting non-operating expenses from operating profit leaves net profit. Net profit is the amount of money left after paying for all your expenses. This is the money that the company could return to its shareholders as dividends, reinvest in expanding the business, or save for future needs. Behind every yearly budget, there are a number of assumptions about how much income we're going to have during the course of the year. But if we lose a major program award, we won't have the income, and we find that we'll have to cut our expenses as well. We do this all the time as individuals. We may be planning on taking a major 2-week vacation for a once-in-a-lifetime experience, but if we lose our job or have a major medical issue, we cut corners and readjust our plans. I hope that this overview of financial accounting has helped you understand the big picture. If you'd like more detail, please feel free to take your favorite accountant to lunch. If you'd like any more information on any of the topics we've discussed so far, please investigate the 3 options shown above. First, you could buy the book. Both electronic and hard copies are available, and you can order those from your favorite bookstore or most of the major online retailers. Second, you could take the 2-day professional development class. If you'd like more information on that, please drop me an email at the address shown. Finally, you could subscribe to our new YouTube channel, BM4SE. Please tune in and look for future posts in the very near future. Thank you.